Okay, everybody, let's get right to this. So it was a great day for mortgage rates. I've been saying every week over and over, wait till March 10th, wait till March 10th, wait till March 10th, wait till March 10th. Well, today is March 10th. And mortgage rates are in the middle of a rally. We're coming back. So what happened today? Well, we had the jobs report, which came in actually slightly above expectations. But the good news is that some of the other data, if you dive deep into the data, it shows economy slowing. Unemployment rate went up today. Average hours worked went down. These are all good news for mortgage rates. I get a lot of my information from Barry Habib at MBS Highway. I'm going to bring on Barry's morning report today to give you some updates. But listen, the good news, we've had a great day, great couple days for mortgage rates. We're in the middle of the rally, so let's put our rally caps on. And here is Barry. So bring them on.
Good morning, everyone. And it certainly is a good morning in the bond market. We were up 75 basis points after a really good rally yesterday of 50 basis points. So, wow, things are looking good. Remember, we had a rollover yesterday, so the chart actually understates the gains. We are in very good shape this morning. The 10-year Treasury down 21 basis points to targets that we anticipated. Look, you've been hearing me say that the stage is set. All we need is a bit of a friendly bond number. But not only did we get that, but we got some trouble in the banking system that we're going to take apart and explain the cracks there as well. So we'll tackle one thing at a time, first of all. So the job report, let's review this together. So first off, when it comes to the numbers on jobs, you always have to dig very deep. And we found a couple of things very interesting here. Okay, so number one, showed that 311,000 job creations. And we're going to pull up a chart for you here. And as you could see, 311,000 jobs. Now, there was an estimate of 225. So on the surface, better than expectations, right? So the past couple of months were revised lower by only 34,000. So the net effect here is, we were better here by, let's call it 80,000 or so, 78,000. But we also lost 34 on the revision. So about 50,000 better there. So that seemed on the surface to be better. But now for the cracks. We had 177,000 jobs that were created in the household survey, not nearly as much, but the labor force increased, people coming back looking for jobs, 419,000. Remember a couple of things here. Remember that SNAP, the food stamp program, that ended. Remember that we are seeing maybe people running out of benefits. So we are seeing now maybe people re-entering the labor force, and that caused the unemployment rate to move up from 3.4% to 3.6%. Now, remember, this is without those crazy population controls. We're seeing the unemployment rate move higher. The non-seasonally adjusted unemployment rate was really 3.9% for the second month in a row. But there was a big jump. I want to give a hat tip to Jake here, who just jumped out at him. And as we took a look at it, here's what had happened. A very little known statistic here. Those that have been unemployed for less than 5 weeks, that jumped by 343,000. So look, team, I just want to explain this to you here. So I want you to take the image of a bucket of water, okay? So the bucket of water is those that have been unemployed for less than 5 weeks. So if you lose your job, you're getting poured into that bucket, right? And what comes out of the bucket, the drain of the bucket, is if you found a job, or if you're unemployed for greater than 5 weeks. So when you take a look at the jump, this filled by 343. What could have caused that? Well, what could have caused that is if the hose going in, filling it with new people unemployed, would have jumped dramatically. But we know that's not the case because according to the Bureau of Labor Statistics, we see initial jobless claims dropping significantly during the sample period. It was only like 194,000. So very low numbers. And that wasn't a change. That wasn't a move up. So the inflows weren't coming in at a greater extent. So what could be causing this bucket to fill? People are not finding jobs as quickly. That's what's causing the bucket to fill. 343,000. That is a very big number. And it tells us that this job picture is showing cracks. This is an acute situation. It is a change over the very near term. The data doesn't show these things until later. So let's continue here. And I want to show you as we go into a couple of other points, the average hours worked weekly. dropped 34.6 to 34.5. It seems like a small drop, but we know this. This is one of the first things that change. If your business is busy, before you hire people, you demand more from your workers. So hours go up, not down. So just like before you hire, you increase hours. Before you let people go, you decrease hours. So another crack, a canary in the coal mine. And average earnings were up the smallest gain in a year. And we see them only up 0.2%. And then as a result of these two metrics, the weekly earnings drop. But remember, how much is left in the tank? We've been showing you this last couple of days after the ADP report. We've been focusing on this because we had another 105,000 job gains today in this report, which was for February, from leisure and hospitality. How much is left in this tank? Not much. And when this runs dry, and remember, JOLTS showed that openings, which is a real leading indicator, declined by 194,000. You are not going to see the job gains that you saw before. So certainly lots of cracks here, but also, Dan, unfortunately and scary, what the Fed is doing to our banking system with the inverted yield curve.
Well, the Fed said they wanted to cause pain, and they certainly are, but it's having some unintended consequences. Remember, the Fed doing all of this hiking since last March, causing the yield curve to invert. That means that shorter-term yields are much higher than longer-term yields. We just talked about the spread between the 10-year and the 2-year being negative 120 basis points. So how is this impacting banks? Well, let's talk about how a bank works, first of all. The bank takes your customers, the deposits from them, and they don't keep those for free. They have to pay them a certain level of interest. And then what they do is they try to make the arbitrage or the spread on then going ahead and lending out money in a longer duration, right? You have your, adjustable mortgages and stuff that they hold. You have longer term investments that they make. Maybe they're investing in longer term bonds, like let's say 10-year Treasury notes. And they try to make that spread between the two. But since the yield curve is inverted, they're having to pay those depositors much, much higher percentage points. So that really erodes any gain they have. But what if these banks now want to go ahead and borrow money? Well, let's just use an easy example here. Let's say that they own $100 million worth of 10-year Treasury notes. But when they bought those, the yield on those was, let's say, 2%. Well, now in the going market, let's say it's 4%. Well, that means over the next 10 years, they're going to lose 2% a year, or let's say, call it 20%. Now, there would be some discounting for present value of money there. But let's say, on $100 million, they lose 15% on that. Well, now, if they try to get a loan and they're looking at their assets that they have to be valued much lower because that increase that you've seen in rates. So this is a bad situation for banking. It's certainly raising some fears out there of, are they well capitalized enough? Are there going to be runs on banks? And all of this fear out there is certainly helping the bond market. And the Fed's in a tough pickle. They want to keep hiking, but now having these cracks show up from them hiking rates so aggressively, I think there's a 0% chance the Fed's going to be able to hike 50 basis points on March 22nd.
Yeah, Dan, this is just showing you the Fed, they're inexperienced. They did it in 2020. We addressed the Fed doing those cuts and doing the QE so rapidly. They think they're doing well. It's just kind of like, imagine, heaven forbid, there was a patient that was ill. You give them a dose of medicine and they don't bounce back in 2 seconds. So you give them another dose and then another dose. And you overdo it. They overdid it to the downside. They're overdoing it to the upside. They keep saying data dependent, but data lags. I wish they would understand this. And they are going to break something, and it's already breaking. They're breaking things in the economy. They're going to break the job market, and they're going to potentially now do something really damaging and break the banking system. And this is something that is a major concern. So look, it's great that we had seen rates come down. We like this, but this is actually a fear out there with the banking system that we have to keep a watch on. And Dan, you named it. You said the Fed wants to fight inflation, but because they went about it in such a silly way, in being so aggressive, and also it's their fault that they didn't take any action. They were asleep at the wheel. Now, by doing things so aggressively, they're going to break things and not allowing the system to adjust. And these are the consequences of their lack of business sense and their lack of experience of anything in the real world.
No.
So some of this news, some of this bad news for the job market, some of this bad news for a banking system, some of this bad news when it comes to mortgage rate, because I'm in the mortgage rate business, but when it comes to mortgage rates, bad news is good for mortgage rates. So with that, this week, 30-year mortgages were, over 7% a week ago, even earlier in the week. And now we're, approaching the mid sixes and could be on a rally down. So again, thank you again for joining. This is Jerry DeMaio from mortgage-zoom.com. If you want to schedule a one-on-one appointment and find out what works best for you and your family, go to www.mortgagezoom.com and we could have a Zoom appointment that looks a lot like this. It's been a great week for mortgage rates. That's good news because we've had a lot of rough weeks, but good news for mortgage rates. Things are looking better. Things are looking up, and by up, I mean coming down. Thank you again. We'll see you next week.